Okay, good afternoon, everyone, and welcome to College and Career Pathways, where every Monday, Wednesday, and Friday at 2 p.m. we provide you with information on various colleges and universities, financial aid resources, technical schools, training programs, and skilled trade professions, and career readiness skills, all designed to help you make the best career decisions possible. I'm Toni Cureton, your host, and today we are back with Michigan Schools and Government Credit Union, and they are continuing our financial literacy series. And today we're going to talk about understanding what a mortgage is and how you go about applying for them and all that good information. Colleen, welcome back. We're so glad to have you. You're on mute, Colleen.
I did just notice that. Thank you, Ms. Cureton. Good to see everyone. Happy to be back. Yeah, ready to go. We have one of our favorite videos here on mortgages, introducing the concept, and we will expand on it further. And I believe I'm already sharing the screen, right?
Yes, you are.
Hey, what's the big idea?
Oh, I'm sorry. I didn't realize you lived in there.
I don't. Well, not yet. I'm just here for the open house.
Are you gonna get it?
Well, I'm not sure. It kind of depends on the mortgage rates.
Ha! Good one. You're not joking. Sorry, I didn't realize hermit crabs need mortgages.
Of course we do. It's the biggest purchase of our lives. We usually need a loan to make it happen.
If I were you, I would just find the mortgage with the lowest interest rate and go with that.
It's not that simple. When shopping for a mortgage or any loan, financial institutions have products with an advertised APR, which stands for annual percentage rate.
That's what I mean. Just go with the one that has the lowest APR.
But you can't compare them at face value. The APR represents a combination of things. The interest rate, yeah, but also a wide range of additional costs. And if you're looking at an adjustable rate mortgage, the APR doesn't even tell you what your maximum interest rate will be.
You've lost me.
Look, mortgages come in two basic types: fixed rate and adjustable rate, also known as variable rate. In a fixed rate mortgage, the interest rate is set when you take out the loan, and it does not change over time. The amount you pay monthly will stay the same for the entire term of your loan. In an adjustable rate mortgage, the interest rate, and therefore your monthly payment, is based on current interest rates in the economy. If the index they're based on goes up, so does your rate, meaning you'll be paying more. If the index decreases, so do your payments. An adjustable rate mortgage often has a lower initial interest rate, which is very appealing.
Fixed rate, adjustable rate. How do you choose the best one?
It's always a trade-off. Fixed rate mortgages are more stable and easy to budget for, but have a higher interest rate overall. Adjustable mortgages have better rates, but are riskier because your rate may increase over time. You have to think about your income, your future, how long you plan to live in the home, your financial risk tolerance, and that's on top of weighing different mortgage types, interest rates, and amortization schedules.
Gesundheit.
Huh? No. Amortization. It's how your loan repayment is broken down into regular installments over a fixed period of time. An amortization schedule shows you how much of each payment is going toward interest and how much of it is going toward the principal.
Is it that hard to figure out? If your interest rate is 3%, then 3% of your payment goes towards interest. Am I right? Your face is telling me I'm not right.
That 3% is the annual interest rate. If you take the total amount owing on your mortgage and multiply it by 3%, the result is what you'll pay in interest in the current year. But the monthly payments work a little differently.
What?
Let's say you take out a 25-year mortgage for $150,000. It's a fixed rate, so you're paying $711 a month. In your first payment, $375 will go towards interest, and only $336 will go toward your outstanding balance. So even though you've made a payment of $711, your balance has only decreased by $336. The following month, because your outstanding balance is now $149,664, the interest portion of your monthly payment will also be slightly lower, and the principal portion will be slightly higher.
So looking at the entire stretch, even though a big chunk of my monthly payments are going towards interest at the start, over time, that kind of flip-flops, And by the end, more of my payment is going towards principal than towards interest.
Now you're getting it. Using this example, after 25 years, you will have made over $213,000 in payments on your $150,000 loan.
Whoa, that's serious.
All the more reason to know exactly what you're getting into before signing everything. People get into trouble by committing to mortgages they don't understand. It happened to a friend of mine. The bank came and took his shell away. He had to move into a half-eaten ice cream cone until he could figure things out.
That's rough.
Mortgages can be an empowering experience or a living shell. It all comes down to your understanding of the mortgage products available, honesty regarding your personal finances, and clarity about your life situation. As for me, this is a little too much home for my budget. Time to go house hunting. Keep it real.
All right. Very, very cute. Gotta love Jen and her adventures. Okay, now we can see these slides. Correctly demystifying mortgages. And it's literally stating demystifying, as in like, I really have no idea. I'm completely lost that mortgages are this complicated process that, kind of like calculus, where you're like, well, I know how to do math, but I don't know how to do calculus. We're talking about the basics of mortgages, getting the understanding how it's different from other loans, but we're not going through every single step of getting a mortgage. Buying a home is probably the biggest expense, is probably going to be the biggest expense of your life. It may not be. You may buy a business, you may buy a cottage, or well, I guess that's also a home, but likely the most expensive thing, hundreds of thousands of dollars, anywhere between 100,000 and millions of dollars. You don't have that cash. You probably don't have that cash. If you're lucky enough to be able to buy cars or pay for college with funds you already have, not taking out loans, that's wonderful. But when it comes time to actually buying a house, owning property, it's a mortgage. You'll need a loan. When shopping for a mortgage, financial institutions have products and an advertised APR. Now, you've heard APR before. We've talked about APR with credit cards, with loan basics. It's the annual percentage rate, the interest rate, the extra money you pay on top of what you borrowed, right? Paying some interest is fair. How much do we want to pay? A little bit, a lot. So we want a low number, right? We always want to make our interest rate as low as possible. In, say, an auto loan, the interest rate is really important because that's about half. That's a big part of the loan, the interest rate and maybe the term. But that's about it. When there's a mortgage, when you're applying for a mortgage, there's a lot of different factors. So the interest rate is just one factor. So don't get not blinded, but distracted by other things and focus on just a good interest rate. What are some other things to look for? Right, they mentioned that there's insurance, taxes, administration fees, penalty fees, origination fees, title fees, inspection, appraisal, all of this stuff. So maybe I can give you a great interest rate, but if I'm charging you a lot for those other fees and you're not really asking about them because you don't know about them, you might sign something that we don't understand, or you might sign something that has consequences for you, negative consequences, unfortunately. You'll need to decide between a fixed rate and a variable rate, or when we say fixed rate and variable rate for credit card rates, Fixed rate and adjustable rate for mortgage is essentially the same thing. It's a mortgage rate that can be adjusted. It has it has limits to how much it can go up or how much it can go down, but it's not fixed. Fixed rate stays in place. Same as a auto loan, a credit card, mortgage, any interest rate that's a fixed rate is not going to change, is going to stay the same. Adjustable rate could change throughout the term. And when we say term, remember, we're talking about how long it takes to pay the loan back. Is it 3 years? Is it 5 years? Is it 10 years? When we talk about mortgages, a lot of times we're talking about 30 years, 25 or 30 years worth of making payments. That's a really long time. So the national economy, you know, the benchmark of does the rate go up or down? You'll hear on the news of inflation, or, you know, the Dow Jones went down, or the economy's falling, all of that complicated stuff in the Treasury that determines whether, for instance, right now, mortgage rates are quite high. They're very high. They're in the 5 somethings, 5, 6 somethings. Whereas only a year ago or 2 years ago, they fell as low as 3%. And you might say, well, so what's 2 or 3%? We'll see what the difference between 2 or 3% is. So your payment can go up. Your fixed rate is predictable. Your fixed rate stays the same. Your adjustable rate could go up or down. You need to be aware of those limitations. How often can it go up? How much could it go up to? Is it just 1%? I believe it can only go up 1% over the course of like 5 years or so, but you would want to have that information. How high could it go? Fixed rate stays the same. It's easier to budget for. I highly recommend fixed rates for credit cards. We talked about that. Most auto loans are already going to be a fixed rate. And mortgages, there's plenty of perfectly good adjustable rate loans. But starting out your first house, try to find something fixed that you don't have to worry about. Next year, is my housing payment going to go up by $200 a month? You want to know that you can plan for, budget for the next 5 years. I know my house payment is going to be the same for the next 5, 10, 15, 20 years. The adjustable rate, and they call it an ARM. You get an ARM loan because, adjustable rate mortgage, nicknamed ARM. It's one that changes over time, where when you sign up, let's say you sign up a couple years ago when it was 3%, you get your mortgage, and then time goes by, and this year, rates go up, and maybe now it's suddenly at 4 or 5%, and 1% of $150,000 is a lot of money. 2% of $150,000, $200,000 is a lot of money. So you need to be prepared for the potential surprise of wow, I might have to pay $500 more a month, $100, $300. So you can get a good adjustable rate, but I would say, at least for the first house, try to find a fixed rate. Thinking about your income. When you buy a car, you're usually thinking about your next 5 years. Am I going to be using this car through my next 4 years in college, through up until I move out of my parents' house, or, oh, I'll just drive it for as long as I can, but that'll probably be like 5, 6, 7 years. You're thinking in short terms, relative short terms. When you're thinking of buying a house, purchasing a mortgage is buying a house. You don't write up a mortgage for rent. Rent is a lease, just like I think we talked about renting. It's like leasing a car. You can rent an apartment. This is buying a house. Have conversations, talk to people, ask questions. I say it hundreds of times, ask questions. I will always suggest credit unions. Credit unions are not for profit. We want to help. We very likely have a lower interest rate that we can offer you than a bank or a financial company that has a lot of hidden fees that can also offer you a low interest rate, but has all these hidden fees underneath it. We have home buyer workshops, free, virtual, and in person. You have personal mortgage consultants that can walk you through every step of the process. People are terrified of getting a mortgage. They think it's going to be the most difficult thing. If you ask for help, there's amazing help out there now. There's DocuSign where you don't even have to meet up. Going through COVID changed a lot of stuff, right? So relax, ask all the questions, ask anything you can think of. So we're looking at the application period. Do we take this adjustable rate or this fixed rate? Okay, we're going to go with this 3% fixed rate from the credit union because they said if you attend the home buyers workshop, we'll give you a coupon for $375 for an appraisal, which is true, which is actually true. So $375 for an hour of your time is a lot. But how does that process work? I mentioned we're thinking about cars short term. Mortgage repayment, 30 years, 25 years. You can't just think ahead for a short term. You need to know that you're able to support and pay the taxes and the insurance and the interest and this large payment for 25, 30 years. You got to really think ahead and be sure. An amortization schedule is a chart of your payments or your payment schedule. If it was an installment loan and you're paying the same amount every month until the end, it would just be a straight line, right? Because it's a fixed rate. It's a fixed monthly payment. This schedule shows your total payment. You'll see broken into principal and interest, and how much you pay to principal and how much you pay to interest. When we say principal, that's the balance. We're going to use the example of $150,000. You owe your principal on your very first payment is $150,000. The interest on your very first payment is 3% of $150,000 divided by 12, which I believe, there we go. Let's say you have the $150,000 mortgage, 3% interest rate, 25. Now, normally you go for 30 years. If you have 25, the payment might be a little higher. Just ask for both, ask for the information on both, but you can request 30 years. And your payment would be $711 a month. Okay, let's see where they got that number from. Monthly payment for a fixed rate mortgage is the amount paid by the borrower every month that ensures that the loan is paid off in full with all of its interest by the last payment, by the end of its term. It schedules in all of the monthly interest, breaks it down, and shows you exactly how much each month you're going to pay for the next 30 years. So this is how it's calculated. We mentioned $150,000. That's the very first payment times the interest rate, 3%. That number is $4,500 annual percentage rate. So 1 year times 1 year, 3% is $4,500. Now we're talking about a monthly payment. So we're taking this year amount divided by 12 equals 375, right? So this month, this very first month that I'm paying off or making a mortgage payment, I am going to pay $375 in interest, just in interest. $375 will go to interest, and only $336 will go towards the 150,000. It's almost splitting them half and half. It's not that you start paying the balance off first and then you pay the mortgage. You're paying 3% of the total. It's like a credit card. You pay interest on the balance that's carried over to the next month. By nature of how a mortgage works, the balance is carrying over to the next month and the next month and the next month for years, meaning it's always going to have that 3% annual interest rate. So people don't think about that. That's why that interest rate is really, really important. If you were paying $375 a month and you could get a lower interest, or you were paying 5%, or 6%, let's say 6%, because it's totally likely right now. We're talking $9,000. That's $9,000 in taxes. Now we're talking about interest. That's $9,000 in interest if we're talking through 6%. And you'd be doubling this. You're paying $700 just in interest. I mean, that's so much money. So as you make payments, just like a credit card, as you contribute to the balance, as long as you don't add to it, as long as you are just paying the balance down, each month you pay a little bit less interest. We paid $375 on the very first month. So when we get the bill, instead of you owe $150,000, we owe $149,664,000. So the interest is slightly less, divided by 12, 374. And the next slightly lower total equals a slightly lower amount divided by 12 equals a slightly lower monthly payment, and on and on and on. So as time, let me go back to this one. As time goes on, instead of being, equal, this 375 number starts to go down, and this 336 number starts to go up, because you're making the same $711 payment each month, right? So how much of that $711 is going towards your interest, and how much is going towards your principal? In the beginning, again, about half and half, and then the interest is less and less, principal is more and more. By the time you are finished making that very last payment, 25 years from now, 25 years, you will have paid $213,395. So the total amount, if you add up all of your monthly payments that you've made, equal $213,000. So you got your $150,000 loan. That's how you were able to get your house. 3%, like I said, that's a really low rate. And that's, $70,000 in interest. That's almost 50%. Half of 150 is 75. That's almost $75,000 in interest. You would never buy you shouldn't buy a car. If you buy it for $20,000, you're going to end up paying an extra $10,000 in interest. Too much. You have to think about the interest rate. You have to think about whether the adjustable, if it suddenly goes up to 4, 5, 6%, by the end, maybe now you're paying $80,000, $90,000 out of 150. You have to ask all the questions. Understand before you sign. There's lots of stuff to sign. Just like deciding on the house, I'm not going to do a buying a used house, like we did for buying a used car. There's a whole other process to how to do that and how to budget. But you can come to the credit union first. Look, I like to buy a house. I think it's time for me to buy a house, but I really don't know where to start. Okay, we'll get you with a mortgage consultant. We'll have, sit down, or he'll call you, answer all your questions. Well, first, how much do you make, and what kind of job is it? Who else is going to be living there? Sounds like you can maybe shop around with this number. Why don't you come in? They'll help you figure out where you can look, people that can help you look for the right types of homes you're looking for. This presentation is only getting into principal and interest, which is pretty much how we've talked about loans so far. Just the balance of what we owe plus the interest. A mortgage, because it's special, because it's a house, and because it's so expensive, there's other costs. You have to pay home insurance. In the same way you pay renter's insurance for an apartment or an automobile insurance for your car, you need to pay home insurance. So let's say 1 year is $1,000. Let's say it's $1,000 a year for home insurance. Okay. Or let's say it's $1,200. It's $1,200. It's pretty likely you could add $100 just for insurance extra. And then you don't think about taxes. It's not sales tax. You're paying property taxes, and you're paying property taxes based on the city you live in, the zip code you're in. They can explain all of that. It depends on the area you are, and you'll want to know. This is a huge conversation because some cities have much higher tax rates than others. So that's quite honestly a few more $100. That's another, let's say $350. Let's say even $300. So now 7-Eleven is your payment towards, the payment and interest, but you're making another $400 payment on top of that for the insurance and the taxes. So when you're budgeting, you have to budget for a payment being at least, $1,100, a much bigger cost than just that $336, I believe, is the amount that's actually going to the balance of paying off the loan. So understand, you want to ask questions looking for a house. You want to ask questions before you commit to a lender. It's perfectly fine to comparison shop. Again, I recommend MSGCU, but it does not hurt our feelings if you go somewhere else, Lake Trust, Genesis, DFCU, and sit down with them and say, what can you offer me? Do you have a promotion going on? What kind of interest rate could I get from you? If that's what you want to go with, then that's fine. It will not hurt your credit report. And I'm kind of jumping topics here, but just so you know, it will not have a negative impact on your report by applying for multiple mortgage loans just to see what the offer is, thinking, oh, well, they're going to run my credit report, it's going to hurt it. If it's all at the same time, if it's within the same 2-week period, even with the same month. Hello, is it still on? Oh my God, I think we lost power here.
Yeah, you're still on.
Okay. Where was I, Miss Cureton? I was oh no, it's again. All right, well, let's do you have any questions? That's all for me on mortgages, unless you can think of some more question.
Okay, you guys, if you have any questions, please feel free to unmute and ask, or if you prefer, you can type them in the chat box and I will be more than happy to read them for you. Typically, when people are applying for mortgages, Colleen, do they need to have a down payment?
Not for the application process. The application process, you don't even have to have a home in mind. You don't even have to have started looking at a specific house. You may just want to know what the pay structure is. If it's a higher interest rate because of your credit, 6, 7, 8% you have to pay. Well, if you can only afford $1,000 payment, that means the price of the house you can look for goes down. But if the interest rate is lower, like 3%, well, maybe, more of your payment can go to the principal. So now you can look for maybe more of a house. So just applying is kind of getting a sense of what are your payment options in a price range. And then from there, you have time limits of, this is good for 30 days, or this is good for 90 days or 1 year. But shopping around, applying, you shouldn't have to pay. Well, you don't pay to apply. But if you are actually putting in your application saying, yes, I would like to get a mortgage here, then there's a lot more paperwork to be provided. But if it's just a general, looks like you're approved for that 150,000, and will probably looks like it will be somewhere in, but 3% and 4%, based on if we can verify, these things and proof of income and XYZ. You're like, okay, good. So that's a good sense of what'll happen when I come back, when I'm sure of the house that I want.
So then a good rule of thumb would be to check into all of this information well in advance before you're actually interested in purchasing a home.
Yes. And absolutely talk to, I'm just going to stop here. A credit union. I suggest credit unions, but talk to your financial institution. Are you ready? Is this the right time for a mortgage? Why is it that you are interested in buying a house? Let's talk about renting, how much you're paying for in rent. Do you plan to still live in this area for 5 years? Do you, if you plan on moving away 3 years from now, don't lock yourself into something that's 30 years. Maybe your credit is worse than you thought it was. It might be better than you thought it was, but if it's worse, you'll need to work on some very specific areas. What can I do to raise my credit up? So maybe in 6 months, when I come back looking for a house, I can get a better interest rate. It's riding that wave. It's juggling. It's looking for the best time to take advantage of an opportunity. What do they say? Luck is timing meets preparation. Have the information available, have the questions ready to go, and it should not be a difficult, painful process.
Good deal. You guys have any questions, comments? Oh, that's great. Someone's a member of MSGCU, Colleen.
Excellent. Thank you.
Absolutely. All right, then. If there aren't any more questions or comments, then we will bring this session to a close. Thank you so much for joining. Thanks, Colleen. Excellent presentation as always. And we will see you all next time.
Thank you. All right.